Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, November 13, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. There's definitely items that we have to discuss today. There's a lot of stuff going on. I did take some time out towards the end of the day to catch a little bit of the media, see what they're talking about, only because we had a failure today. So I know that that's on their mind. I know they think we're going a lot lower. We'll get to that in a few minutes, but we do have stuff to discuss, so I want to get after it. Before we do, let me first make mention and thank everybody for participating, making comments and posts underneath the video each and every night. I love the interaction. Keep up the great work. It works for the entire community. In addition, please hit the like button and share the video with anybody that you think can benefit from this information. Okay, so what do we have today? What we have today is a market that went higher earlier in the day and failed. There was distribution at the highs, so that was a fake out. It was a gap and crap, whatever you want to call it. Well, we can't call it a gap and crap because we actually opened, went lower, and then went higher. But the point is that the market failed. In fact, while we're discussing it, we might as well look at the 10-minute intraday chart. So the day started over here. So right here is the 940 candle. That's the first 10 minutes of the session. Market went a little bit higher, dipped lower, made a new low from yesterday, then rallied up. And this is the way the market really whips people in and out. This is how they chop people up over and over and over again. And a lot of this kind of behavior has a lot to do with options expiration week. That's in my opinion. Doesn't happen like this every single day and each and every week during options expiration week or each and every month. But nevertheless, it happens a lot, and they send the market up, they send the market down, and at the end of the day, we really didn't go anywhere. But intraday, we did have some wide swings. Again, when the market's in a downtrend, and technically speaking, we are in a downtrend from a longer-term perspective. We'll talk about looking for a low and what happens after that. We'll discuss that in a couple of minutes. But when the market's in a downtrend and we've had an increase in volatility, the intraday swings are wider. The intraday ranges are wider. So we get these large swings in both directions. So 10, 12 points in the S&P in a matter of minutes becomes commonplace. By the way, since we're on the 10-minute chart, let's think about it for a second as if we were in real time. So it's this morning, mid-morning, the market starts to catch a rally and starts to go up higher and higher and higher. And all of a sudden, we close a candle above an important level. That's bullish in and of itself. So we had a big breakdown candle, the market rallied back up and closed the 10-minute candle above that price level. That's bullish. I'm going through the mindset in real time. So that's item number one. Then you have to think, okay, the market's on its way up. It's a recovery. We're looking for a low. Maybe we saw the low. Do we hop on board? What's next in terms of resistance? Now you have to realize in real time, everything is turning bullish. I'm not listening to the television, but I know most of you are. Whatever they were discussing while the market started to turn, turned bullish. They had positive conversations. It feels like the market's turning around. You start to see stocks start to rally. Apple started to turn around after making a low almost to that gap. We'll talk about that later. We talked about it last night. So in real time, it feels like everything's making a shift. But do we know otherwise? Is there another reason why the market would find another likely level of overhead resistance? Well, yes, there is, only we never actually got to the ideal spot in my book, and that's why I wasn't able to take a short trade. I was looking for one, but I didn't take a short trade because I wanted the market to get a little higher. Let me explain what it is on a 60-minute chart. Before we move over there, make mention of a couple of other things. So while we're looking at it in real time, your eye gets drawn to that gap and you say, well, is the market going to go fill that gap? At the time, it's far away, but as the market turns bullish, you know how fast the market can rise and how fast the market can fall when you start to get real buying pressure or real selling pressure on the other side. So who wants to get in front of that on the short side? I understand that. But there's also a couple of natural areas of resistance. These are taught throughout the course at Lazy E-mini Trader. I'm going to show you one of them on a different chart. Here's the 60-minute chart. So let's refocus on where we are. So here's the candle that represents the hour in which the market was headed higher. It looked like a recovery was at hand. But we also know, and it looks different on the 60-minute chart, we also know that as long as the market stays beneath that level, beneath that price level, the high of the breakdown candle, this is nothing other than a bearish wedge pattern, a bear flag pattern, a bearish pattern. Any way you want to look at it, whatever you want to call it, it's bearish until and unless the market would be able to close above the high of the breakdown candle, which at the time also coincides with the convergence of the 250 period moving averages. That's why we use various different charts to get a picture of what we're looking at, a visual of what we're looking at. It counts in the weighting of how we make decisions. Visually, does the chart look right? Do the numbers match up? What do the patterns say? Where are the important pivots? Where are the important resistant areas? Where are the important support levels? How long has a market been moving in one direction or another? Has it put in a signal of a trend change or not? All these things are what goes into the crock pot and makes the soup of a successful trade. Now, when you go look at this hourly candle, what were we doing? We were running up to test the high of the breakdown candle. Now, that's item number one, and anybody that's taken the course at Lazy E-mini Trader can identify a second reason right out of the chute where we were into and there was another one right above, very important overhead resistance. So what you really did have, when you just filter out the noise and you put blinders on, you had a bucket full of reasons for a short trade by the book. And that's my book, not any of those other books. Did I take the trade? Absolutely not. Why? Because I was waiting for a higher price. Turned out to be the wrong thing to do, but I was waiting for basically the high of the breakdown candle. I didn't get filled. It is what it is. I miss trades all the time. I miss trades on stocks every single day. I miss trades on an index, whether it's a short or a long trade, all the time. Why is that? Because I want my price, not somebody else's price. If they're not willing to give me my price, then I'm willing to forego the trade. You have to have that attitude and mindset. It has to be on your terms, not theirs. Back to the daily chart. Let's discuss what's going on from here, right? I left that out so far, so already you've had to hear me babble on without hearing what's going to happen next, so my apologies for that. Are you ready for the new revelation? We're looking for a low. Was it today? Is it tomorrow? Is it the following day? I'm not 100% sure. Will they come down and fill the gap? Will they get to 269? I'm not 100% sure. I don't care. I'm beginning to collect what I want in terms of positions in the stocks where I think they're at discounted prices. If the S&P, if the spider comes down to 269, 267, 268, in that general neighborhood, or even close to 269, intraday, I'll make a decision on whether or not I want to take a position in the index itself, but certainly if and when the market does come down to those levels, I'll have been accumulating more shares, both shares and option contracts on certain stocks. It depends on the stock. It depends on the situation. It depends on where I believe I can get the biggest bang for my buck, but I also have to weigh out how long I'm willing to wait. So, for example, with some of the positions that I take using option contracts, I give myself time. I'm not looking for an option contract that's expiring next Friday. That's not the prudent thing to do, and let me explain why. Let's suggest for a second that it looks like we put in a low today, the market begins going up tomorrow, and it has follow through the following day, and you think we're out of the woods. Here comes the ABC pattern we discussed, and you think that the option contract is really going to pay off. However, we end up turning around, going back down the other way, and you have to spend another week waiting. While you're waiting and price is going against you, we know the premium in that contract deteriorates. Specifically, it deteriorates on the near-term contracts. So I give myself time, but I understand you don't get the biggest bang for your buck, but I'm not necessarily looking for the biggest bang for my buck. I'm looking to maximize my capital. And I do what I perceive to be the smart thing at the time. Doesn't always wind up being the smart thing, but at least that's my attempt. Is there anything on the daily chart of the spider that indicates a low? Not really. It looks like the market wants to go lower. We're below the 20-period moving average, and we're really nowhere near what I would consider a significant support level. What happens when you look at the futures contract? So just for a minute, we'll look at the futures and you can see we put in what I like to call a pseudo doji candle. Now, I'm not sure that that's really going to be meaningful or anything. I just wanted to compare and contrast the two, just show it to you, lay it out there, let you know that it's a puzzle piece for me. It's on the table because I'm aware, because I'm looking for a low, I'm aware that certain markets will turn before others. Futures markets have a tendency to do things overnight, and that's why you see markets follow when we open at 9:30 Eastern Standard Time. How about the IWM? Anything good on the IWM daily chart? No. It looks similar to the spider. There's a little issue here. We closed below the low of this breakup candle. So that really tells me that there's a more likely than not chance that we're going to go down and at least get to the window, most likely fill the gap down here that officially comes in at 149.73. So call it a spike through 150 is likely to fill that gap. It's not really that much farther than where we are now. Now, right now, the futures are up slightly since the market closed, but that doesn't mean much because there's a lot of space between the point in which I'm making this video and 9:30 tomorrow morning. Like we discussed last night, all these charts look very similar, close to the same, so there's no point in unpacking everything in particular with the IWM. We know that all the markets are going to move in unison for the most part, not necessarily the same percentage at the same time, but they're going to move in unison on these larger moves. So markets are going to bottom. Some may bottom before others. But if the markets have a relatively powerful move again to the upside, they're all going to follow suit. We all know that. By the way, there was one more thing I wanted to point out on the spider chart. This is the hourly chart, and we have a breakup candle. This is the candle we were discussing earlier from this morning. But what's also interesting is as we came down at the end of the day, we were never able to close hourly below the low of that breakup candle. So I was watching that very, very closely. That would have certainly provided clues on what we could expect tomorrow. For example, if we closed poorly, meaning hourly below the low of that breakup candle this afternoon, that would have told me one thing about tomorrow, or at least something more likely for tomorrow morning to the downside. But we closed very close to the low, but they didn't close below the low. So that's one of the ways that the market likes to trick and trap, and it's all part of the same routine. They leave you guessing at the end of the day. That's exactly the intention. Here's a chart of the transports, and same routine as all the others. The transports tried to stage a rally today. We tested the high of yesterday's high print, but we couldn't hold it, and you can see we failed at the end of the day. But we're above the 20-period moving average. So is this the canary in the coal mine? It may be. We've discussed it before. It started out to be the canary in the coal mine. Certainly money was rotating into the transports on the turn earlier than other markets. If you remember discussing that, you can go back to the videotape around the time of the turn. We talked about this at least a few times. And by the way, I want to go back to the IWM. I'm sorry to jump around, but I have notes here, and sometimes I get off on a tangent. I forget what's in my notes, and then I glance back, and I want to go back to another chart. So we also have more bearish discussion that I did catch this afternoon. Right before I went to make this video, I flipped on CNBC once again, and only because the market's doing what it's doing, I really want to hear what the excuses are, what the rhetoric is, what's going on, what's on their minds, how bearish are they getting? That's what I'm looking for. And so they started discussing, they had some kind of technical guy on, I forget which one it was, but he was discussing the crossover that's occurring on the 50-period moving average and the 200-period moving average on the IWM. He was discussing the small caps, he was discussing the crossover, and this is perfect timing. He's looking for a crossover, saying it's going to push prices much, much lower. He's looking for a collapse. I'm looking for a low. I see the crossover. I understand what's going on. Possibly, maybe, just possibly a little bit better than him. We'll see. But he was looking for the unraveling of the small caps. Now, he may be right down the line, but I don't think he's going to be right next week. And that brings up another good point, and I'm sorry to ramble on, but I'm trying to provide you what I think is at least information of value. I perceive it of value. I think some of you will too. Take that for example. So here's somebody that comes on and gives their opinion, and it makes logical sense, right? If in fact we do get this crossover of the moving averages, and over time the small caps do come under severe pressure, and they're 20% lower than they are now somewhere down the line, he'll have been right, and I'm saying that's very, very possible. In fact, it's probable that down the line he's going to be right and I'm going to be right and we're going to see much lower prices. But the difference is a lot of investors and traders listen to that and they have a hard time separating short term versus what he just said. I know in my heart of hearts, long term, he's probably going to be right. But I know that I'm looking for a low. I can make a ton of money on the long side if I'm right in a very short period of time, just like we did off the last bottom. So the point of that story is you have to be careful when you hear one thing, they could be right. And if somebody came back next week after the market rallied, assuming it did, and they said, hey, you said the small caps were going to collapse, and he'll say, I didn't say next week, and then everybody's right, and that's the problem. Here's back to the transports. We can be done with the transports. They're going to follow suit like everything else. How about the Qs and technology? That's important because we've got to get money flowing back into technology in order to turn this market, obviously. There's a gap down here. It looks like they want to fill that gap. They're coming very close. Be careful because when they go and fill that gap, they might spike it by quite a bit. Real-time type of decisions. Financials look similar to the transports. Everything looks similar or the same. So we had a rally. The rally faded. We finished nearer the lows of the day, not on the lows, but certainly didn't have a positive finish. But this is a garden variety pullback, just like every other market. The Spider, the Qs, the XLF, we had a tremendous rally off the bottom. We're retracing a portion of the rally. My expectation is, back to the Spider, that we have an A, here's the B leg, and it'll come to a conclusion somewhere down in this zone. And then we have a C leg higher, will officially complete at minimum above the high of the A leg, most likely 285, potentially even north of that, as high as the high of the breakdown candle. SMH, same. It's very difficult to draw any other conclusion looking at these charts. They all look very similar or the same. The SMH had a really, really crappy day yesterday, so the SMH got smoked to the downside by like 4 or 5%. I forgot exactly which one. And so it looks a little bit worse, but it's similar to the rest. I'm not going to do the stocks tonight. We're going to do gold and oil. I forgot those last night. Maybe we'll do the bond market as well. But the reason I'm not doing the stocks is really all we had today was a dead cat bounce. Some stocks were up nicely. Others just had a dead cat bounce from yesterday. But again, all these charts look similar or the same, and the stocks are going to follow suit. If the market falls through the floor and we have a lot more on the downside, the stocks are going to follow. If we reverse and have the C leg of the rally to the upside, the stocks are going to follow. That's the way it works. Here's the chart of gold. Now, without going into any detail whatsoever, you can't lay it out any better than this. This is a picture-perfect lesson right from the course of Lazy E-mini Trader. Anybody that's taken the course sees it as clear as day. It's almost hard to add any other words to that. Let's go over to crude oil. And by the way, before we even go over to crude oil, I can see 3 reasons on the chart for what's going on here in gold, and there's probably more. I didn't even look too hard. Hard to believe how crude oil was smoked to the downside. Now, we didn't discuss it yesterday, so we really haven't discussed crude oil since last Thursday, so a lot's happened since last Thursday. So last Thursday was the 8th, so let's find the 8th. So here's the 8th. So we closed 61.5. We'll just call it 61.5. It was slightly higher. It doesn't really matter. Here we are at 55.5 just a few days later. Pretty remarkable fall. Now, you see this line at 57 because 57 was support before it wasn't, at least for me. A few traders, because I forgot to cover crude oil, and my apologies in last night's video, a few traders underneath last night's video asked, what price is crude oil going to? It's going down. And I said, 57, you should see support at 57. But if 57 doesn't hold, we might have to look all the way down to 53, 52 even. I'm not sure exactly where it would go. We seem to find some stability at 55. That doesn't mean it's a low, but certainly 53 would be next on my radar screen. If we begin closing hourly below today's lows, I have to look down near 53. Here's the hourly chart. Are we starting to find some stability? Are we starting to maybe bounce a little bit higher? It's so oversold, and you know how I feel about that term. We talked about it the other day. It's oversold is just a term because there's no definition of what oversold means. A market can stay oversold or overbought a whole lot longer than most people can stay solvent. I didn't make that up. That's an industry term. But look at this downtrend in crude oil from the high. By the way, the reason I had brought up this weekly chart, and I mean, look at this. This was the absolute best trade I never took, at least over the last 4 or 5 years. I talked about the hot zone for months. The market finally gets up into the hot zone. It almost gets to the top end of the hot zone. I'm the only person on the planet that doesn't short crude oil. And look where we are, $55.50. That was about $77. A pretty remarkable fall. So we should be finding a low. Whether the low is at 53, 52, or 55, I'm not going to be 100% sure at this point. However, we should be finding a low in terms of time this week, maybe even into next week. But within the next, let's say, 5 to 6 trading sessions, I would expect we're finding a low, if not sooner. Time is more important than price. And with that, folks, I'm going to give it a wrap here tonight. It's everything I wanted to and intended to discuss. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.